It's about 3:18. Why don't we go ahead and get started again? You could kindly take your seats. So to recap, an indirect cost rate's nothing more complex than A over B, with B usually being the larger number, so that indirect cost rates are expressed as a percentage. However, to get the approval of that percentage requires some level of effort on our part. We've got to put together an indirect cost rate proposal or an ICRP. And they don't necessarily have to be complex. I've seen excellent ones come in under 10, 15 pages, thereabouts. That's what we're talking about. But we generally need, like all things dealing with the federal government, we have to prove everything not once but twice. So some of the things that we need to provide is documentation of how we arrived at A and how we arrived at B, and they even want to see the math and how we arrived at C. Indirect cost rates are based on audited data as a general rule, unless you're a brand new organization, in which case your cognizant agency could approve provisional rates based on estimates. That's generally not the case industry-wide. It's based on historic data. So the auditors are the people tasked with reviewing your indirect cost rate proposal will want to see some number from your audit tied in to your subsidiary worksheets. You have to provide copies of those working papers. You may have to call your auditor and get copies, whatever it takes. You too also have to submit so that the reviewing entity knows that you're relying on audited data, a copy of the audit itself. And whether it's audited financial statements, a CAFR, or a comprehensive annual financial report, the data has to be there, usually verified by some independent third party, your independent CPA. 3, they want to know how you arrived at your direct program base. You're going to want to have a schedule with all the direct allowable costs for Program 1, Program 2, Program 3 in a schedule, including the transit department. It is a requirement in that schedule in the event you elect to use salaries and wages as an allocation base. They usually want to see salaries and wages separated from other direct allowable costs in your schedule. To better understand the relationships between those departments or cost centers that generate overhead or indirect costs, they want to see an organization chart so they can see the relationship between operating departments and benefiting central service or central service contributing departments. And usually some narrative of the overall structure of the government. We're a city council form of government established in 1863 or whatever, some background, usually about a page. And some discussion of the organization's approach to the classification of what you consider direct and indirect. That's usually a one-time submission. You don't have to update that annually unless there are major changes to the organization. The 5th element is a certification. It's about 2 paragraphs. The language of the certification itself is in the super circular. So all you got to do is copy and paste that. And it basically says all the numbers that I've submitted in this report are true. And if not, I promise to go to jail. And I might be kind of paraphrasing the wording a little bit there, but that's exactly what it says. Because just like claiming excess federal funds, you cooking the indirect cost rate, making it higher than it really is, entitles you to draw down more federal money than you're entitled to. you're back in the same boat as if you were overbilling the federal government. That's a felony, that's a crime. So the same language and the same clause about you going to jail exists in that certification. And then you package that up and you submit it to the cognizant agency. And again, that's typically the agency that gives you the most federal money over a 5-year period. And the increments, I think the 5-year cycles are 14 to 19, 19 to 23. It's in the super circular. You can read it there. And technically then, that cognizant agency should review the package on your behalf, may contact you with questions or clarifications, and ultimately responsible for approving your indirect cost rate proposal. The approval basically usually constitutes a letter that's 1 to 1.5 pages long with an attachment. And the attachment's sort of a standardized form that basically will say, the Federal Transit Administration, U.S. Department of Transportation has reviewed your request for an indirect cost rate, and we hereby approve use of the following rates for fiscal years 19 and 20, or in FTA's case, since they only approve 1 year, they allow you to use that rate. And then it will contain some notation that now that you have a federally approved indirect cost rate, you are advised that you should use this rate in a uniform fashion with respect to all the organization's federal awards. And that's all it is. You get that little letter back, and then you apply that rate to allowable direct costs during each billing period in all your federal grant awards. I think I said 50 million, 35 million and above. OMB appoints who your cognizant agency is. The others you maintain on file, submit on request. There are situations, and this always applies to 5311 audiences, when you primarily get your money via a pass-through agency such as the state, it is permissible then for the state to act as the cognizant agency on your behalf. So if most of the federal money you guys get comes from GDOT, then GDOT can step up and serve as the cognizant agency. They can review, negotiate, and approve your indirect cost rates. And most state dots perform that function on behalf of their 5311 recipients. If not, and you go the cognizant federal agency route, GDOT presumably accepts the results of whatever happens from that federal agency. The rate applies to your fiscal year. And again, depending on the federal cognizant agency, most will actually approve rates for a 2-year period. FTA will only do a 1-year period. The super circular permits up to a 4-year period to be approved. I haven't seen much activity with 4-year approval rates, but clearly most other organizations at the federal level will approve 2 years. If you've got an existing rate and haven't used the super circular to go through a new process that meets current guidelines, you are allowed to ask for extensions. These are just a bit of advice. This isn't from the super circular. This is kind of from my background. I think a properly structured, standardized chart of accounts is key to the indirect cost rate proposal preparation process. You need to be able to capture easily and dump from your accounting software items such as eligible cost, unallowable costs, indirect cost, direct cost by program. To the extent that your accounting software is set up to do that from the get-go, the time consumed in preparing an indirect cost proposal literally can be reduced to 1 day. But it all depends on your accounting structure. And the bottom line here is the accounting exists for one purpose, and that's to serve management. Management doesn't serve the accounting software. So if you're not getting the data that you need to effectively manage the transit program, you need to have a sit down with your CFO and your elected board or your governing board to make that happen, because some things are half-assed backwards if that's not occurring. You'll want to ensure that you can readily segregate salaries and wages to meet that one schedule preparation that's a requirement. You'll want to ensure that each fund or program activity is accumulated in its own bucket within the accounting software. Most software can readily do that. Even QuickBooks, which is kind of on the low end of the technical spectrum in the accounting software world, with experienced, knowledgeable people, they can structure QuickBooks to work for you. There's not much literature out there that gives you a step-by-step, holds your hands through the process of indirect cost rate proposal preparation. What is out there is very old. It was prepared by HHS back in the early 90s. Even today, it still represents the single best document, the best how-to that exists. HHS disavowed this document a decade ago, saying that OMB has changed A87, A122, and we don't have the staff or the money to keep up with OMB changes, so ignore our previous publications that you all relied on. Then the super circular comes out, resurrects this from the dead, and says, hey guys, this is still good stuff. We know HHS has disavowed it, but it's still the best thing out there. It's got a little bit of a long-winded title. You can download it from that website, or you can Google it, and if you use the search parameters of ASMB C10, you should find it readily. This is what the cover looks like. And with my sore throat, I'll try to get through this in one breath. But it's entitled Cost Principles and Procedures for Developing Cost Allocation Plans and Indirect Cost Rates for Agreements with the Federal Government, a guide for state, local, and Indian tribal governments. Even though it says it's limited to public sector application, it works perfectly for nonprofits as well. All the presentations in Chapter 6 of this document are what you want to follow, and it prescribes recommended outlines of how to format your tables and work schedules to include in your indirect cost rate proposal. The other thing it does somewhere in this document, and I think it's in Chapter 6 as well, that if you are a small nonprofit and you elect to use what I've described as the direct allocation process, and telephone is the only indirect cost that you want to directly allocate to the 5311 program, it will tell you a basis that should be accepted by all grantor agencies for the direct allocation of telephone expenses, which is the number of handsets that are in each department of your organization. So if you got 10 telephones at your nonprofit and transit has 6 of them, they get 60% of the phone bill. And that gets recorded as a direct expense when you bill transit every month. And that all can be found in this document. Very useful, even though it was produced in 1994. So get your accounting system in order, do your homework, and then approach it systematically. Get your schedules prepared from the accounting system. You want to know your direct expenses, segregated by salaries and wages and other. You want to do the same thing for your indirect expenses. You need to look to see what items must be excluded. If you're using the de minimis rate, you've got to exclude capital, rent, subcontracts over $25,000. You got to figure out what my B is in A over B. You've got to actually do the math, A over B. You prepare those schedules. Rely on audit data, and you may need to call your audit firm in the event you need more detailed subsidiary schedules. I've got some examples of how you can do that here in just a second. So for example, this is a little hard to read, but this is typically what you might find in an audit report. This is what's going to be readily available to you. And you don't even see transit listed for this county government. These are all the various departments here under general government. Transit's buried in the Public Works Department. It's a unit of Public Works. So we don't even have a schedule that identifies direct and indirect costs incurred by the transit agency during this fiscal year. I think this is FY13. So this is what you might extract from the audit report. The auditors likely have subsidiary worksheets that are readily available that you provided. So somewhere your CFO generated this paperwork should be readily available to you. So here's one method of presentation of a subsidiary worksheet that was done for the Department of Public Works. And again, we're calling it the Smith County Public Works Department. And you'll see that there are 3 divisions within our department. We have the Transit Division, the Roads Division, and Environmental Services. And here's their total expenses. And that number right there, the total number, ties back into the previous slide from the audit statement. And you can read that that's $4.936 million. And that's actually what should be right in there. So that way we've tied our presentation to audited data. Here are some of the exclusions for capital. Here were our unallowable expenses by department. We've taken those out. And here are our indirect costs, mostly coming from county administration and some county support service departments. This is the Department of Public Works allocable share of those expenses. Here's our direct expenses divided into salaries and wages and other. And then when we put it all together, here's the simple calculations. Total expenses, exclusions, there's our indirect costs, divided by our direct costs, A over B, 507 divided by 3.9, and we come up with 12.8%. And we would provide examples of that in the indirect cost rate proposal. We slap it together with an organization chart, the organizational narrative, and our certification, and we've got an indirect cost rate proposal. And that's what we submit to either the cognizant agency for audit or the pass-through agency that's going to serve in the role of cognizant. Now, I know we've got some TPOs in the audience. If you were interested in claiming indirect costs in this manner, we generally don't call them indirect costs. They're basically agency administrative, it's general administrative and overhead expenses, and you calculate an overhead rate. There's usually excellent guidance on how a for-profit firm calculates those rates. One of the better guidance documents that I've ever seen should be readily available from GDOT and was produced by AASHTO. And it's the same procedure that consultants would use. It was primarily developed for use by consulting firms bidding on design and planning work let by a DOT. But it works for transit consultants and transit operators as well. And you would typically want to have your auditors prepare that work on your behalf, and you would submit it to GDOT, and it works much like an indirect cost rate. You could figure out what your direct billing is going to be to do Savannah County, or whatever the county is. And then you would add a certain percentage that would reflect some contribution of your CEO, your CFO, your assistant director, your regional maintenance coordinator. Their time will all directly impact all of your local contracts. Rather than bill it on the basis of timesheets and direct documentation, it would be billed as an indirect overhead expense, and it would be a rate as well. Unlike, let me just finish, unlike the rate of a nonprofit, which would typically be in the 13 or maybe 10 to 20% range. An MPO, a regional planning agency, typically in the 40 to 80% range. Private companies, their rates are going to be in the 100 to 180% range, because more of their costs are associated with this overhead indirect than you would have in a nonprofit organization. And that's just Rich's rule of thumb of what those rates should be. That's not based on statistical data. And don't be alarmed when you see a wide range of such overhead rates. That's very common. So go ahead, ask your question.
I'm good.
Okay.
Thanks.
Be aware that once you make that submittal, when you get that 2-page letter, the 1-page letter with the standard format with the approved rate in it, the cognizant agency for indirect cost may also indicate to you what type of rate they have approved. We don't really have to know this, but for educational purposes, there's final rate and provisional rates. If you're a first timer, or if you're a new organization that is applying for the very first time, you may not have the history of financial data in your repertoire, and you may not be able to provide the same level of evidence that someone who develops and submits these things every year for the last 2 decades has. That will provide less credibility to your organization, but shouldn't stop you. What typically will happen is that the cognizant agency will approve a provisional rate, an interim rate, and then let you actually go through the fiscal year. You will document throughout the year actual indirect and direct costs, and we'll do the math all over again at the end of 12 months, and we'll adjust your provisional rate to a final rate. That's double the work for you and the cognizant agency, and it's my observation that most cognizant agencies hate that. They'd rather just go ahead and give you a fixed rate. And there are also still the possibility that within some programs, Congress has limited allowances for the payment of indirect costs, in which case you may be subject to a predetermined rate. But those are the various options that may be available to you. FTA almost always will approve a fixed rate. And I would say 90% of all approvals that I've ever seen are fixed rates. So that's typically the predominant thing that we do there. You compile all your work. I've got a couple graphics in the slideshow. This is the entire process put together, and I've broken down a graphic for each step. So if you've never done this before, you follow the 6 steps. You compile your proposal and you submit. And again, the application, I went through the example. If you're using de minimis rate, you'd figure out modified total direct cost. You eliminate capital, you eliminate pass-through. We don't really have any pass-through funding sources in transit. You eliminate anything else that the cognizant agency thinks will distort the equitable distribution of indirect costs. In transit, we typically don't have that. And we basically multiply direct cost by the approved rate, and we add it to claims claimed by that rate for the billing period. Indirect costs are subject to the same allowability standards. Just because you can't bill it as a direct cost doesn't mean the alcohol for the driver's picnic goes into the indirect cost pool. It's still subject to the same allowability standards. So indirect costs do not contain unallowable costs. If you are a 5311 recipient, subrecipient in Georgia, and you've negotiated a rate with the federal government, it's within GDOT's rate or purview to ask for a copy of that approval letter. GDOT then has really no option but to accept that rate. Those are the rules. Now, there are a couple little examples. Let's just say you don't have a rate approved by a cognizant federal agency, but maybe it's a sister department of GDOT. When the pass-through agency approves your rate, generally OMB says other state departments should embrace that rate as well. They should accept what the sister state department has accepted. But that's not an absolute. GDOT has the right to either accept maybe a rate approved by DHS, or they can negotiate their own rate with you. Since that's more work for GDOT, you know, the theory being, and we haven't seen enough of this in implementation, post-effective date of the super circular to see how this is going to play out. But generally, most agencies, if they can accept somebody else's work, they'll do it rather than do the work themselves. It's just easier and more consistent with the goals of the super circular. If you use the de minimis rate, all that stuff we've just talked about in indirect cost rate proposal production goes out the window. It's not necessary. We don't have to do anything to declare the de minimis rate. But we have to accept that rate's only 10%. We can't move the dial. In most instances, our indirect costs will exceed 10%. So if there's money to draw down, we're leaving money on the table if we go the fast and easy route, de minimis. So generally what I recommend is if you're considering electing to use the de minimis rate, I would have my CFO do some rough calculations to determine what my actual indirect cost was. If it was 11% or less, I'd take the de minimis rate. But if it's over 11%, you're leaving too much money on the table. I'd go ahead and go through the trial and tribulations of preparing an indirect cost rate proposal. The good news is that some elements don't have to be resubmitted every year. Once you develop the templates, you just update the numbers every year and resubmit. It's a cut and paste exercise in the second and subsequent years. As a consequence, once you do the first one, it's not all that labor intensive in years 2, etc. And so once you bite the bullet, it pays dividends. And so that's my advice.
You talked earlier about hiring an independent consultant, independent auditor to do the long.
Yeah, there is a minor stipulation at some level. OMB will not permit the audit firm that prepares your single audit to do your indirect cost rate proposal. There is a financial tie-in of that. I think if your CFA shows that you get so much in federal dollars, you've got to make sure you use 2 separate audit firms.
Do you have to use an audit firm, or can the CEO?
Typically, the CFO of an organization should have the requisite skills to prepare an indirect cost rate proposal. It's intended that the proposal be prepared in-house. It is fully dependent on the generation of financial statements, and it's your responsibility to develop financial statements. So if you can do that, then you can do an indirect cost rate proposal. It's the agencies who hire a bookkeeper and not a trained CFO that have to have the audit firm prepare their financial statements, which is an automatic audit finding, and technically is not permissible, but it happens anyway. Did you have a question?
That says the entity is public or nonprofit may utilize this de minimis rate.
Yeah, public or nonprofit. It doesn't say for-profit.
The public would be profit, right?
No, public agencies earn fund balances. They don't make a profit.
Yeah. Let's think of public, yeah.
We don't use the P word in public sector.
Got it.
We have fund balances that carry over. That's our rainy day fund. State legislators demand that we keep a certain amount of monies in our rainy day fund. So again, sort of the burden on your shoulders. You're lying to the federal government if you claim the de minimis rate when in fact your organization has had a previously negotiated rate with the federal government. You want to make sure that you go back into the history books and make sure you do not have a previously approved rate. It is also permissible to use the de minimis rate as a stepping stone. You could use the de minimis rate in FY19, FY20, and then change over to a full-blown indirect cost rate in FY21. That's up to you. You can change any time at the start of a new fiscal year. And I just wanted to review again, in the computation of the de minimis rate, it includes salaries and wages, fringe benefits, materials and supplies, services, travel, and subawards or subcontracts up to the first 25K. And it's the calculation of MDDC that is, people seem to be getting wrong. And that FTA is kicking back de minimis invoices in trams because this is not calculated correctly. You need to be aware of what goes in and what doesn't go in to modify the total direct costs.
That was direct salaries and wages, right?
Yes. So in other words, what you're saying, if you use the de minimis rate, you'll fill out the GDOT template that might have a list of costs here that could be $100,000 of eligible costs during the billing period. If you use the de minimis rate, you then have to take all your eligible expenses, take out the exclusions. This may only be $90,000 over here. And then you would take the 10%, and get $9,000, and that would be added to this. And so the amount you'd bill GDOT for that billing period would be $109,000. This column will not likely equal modified total direct cost unless something strange happens during that billing period. It could, but probably won't, because of the exclusions, particularly if you've got any third-party contracts. Duplicate slide. And again, your cognizant agency, or whoever you're dealing with when you're using the de minimis rate, they have some say-so what you include here. If the financial professionals at the grantor agency believe that you're including something in modified total direct costs and claiming the de minimis rate, they have the right to exclude items. So there could be additional bullet points not mentioned in the previous slide that should be excluded depending on the grantor agency. So be aware that they have that right. The other thing I think is important to remember is that $25,000 exclusion in subcontracts and subawards is for the life of the contract. So what is the name of your company?
Transition Security Solutions.
Let's just say we have a contract with Transition Solutions for 3 years. I can deduct $25,000 in FY19, but that's it in that contract for FY20 and 21. It's the life of my 3-year contract with Transitions. Now you may say, well, I can beat that limitation by merely signing a 1-year contract with Transitions. And that might make sense initially. I highly recommend that you not do that, because Transitions will look at the RFP and say, they're only offering me a 1-year contract. They're holding out the possibility of subsequent years, but I'm not guaranteed that. That means any of my mobilization and preparation costs all have to be charged out in year 1, or I could lose my shirt on this contract, which means means you'll be paying more for Transitions in year 1 than you would have been if you had said, we're bidding a 3-year period of performance plus 2 1-year renewal options. So it's a more complex equation than it first appears. And don't undermine good procurement planning by trying to manipulate how this $25,000 exclusion works. You'll pay for it in the long run in spades. It just is not a good method. It's the life of the award. And it's often great if you don't have a state-provided worksheet to provide that worksheet as a best practice in your billing to those agencies. And again, it's modified total direct cost times 10%. It's this column times 10% equals a number. It gets added to your allowable cost during the period. And like that formula, the amount we're entitled to in any billing period is our direct cost plus the allocable portion of indirect cost, which in this case is $9,000, minus rebates and credits, and that's what we bill GDOT. And there's sort of a little graphic of the process you would follow in the de minimis rate calculations each month. All right, we're about 3 minutes behind schedule. But it's time for another exercise. Who's got a cell phone? This one may require math. Get your teams together again. Take a look at eligible costs that this transit agency has incurred this period. And I want you to take a look, and I've got, in this case, the updated USOA account numbers and account categories. And I want you to tell me which one of these line items has to be excluded from the computation of modified total direct costs so that we know how to apply the de minimis rate. So document your exclusions and then tell me what's eligible for application of the 10%.
Could we get it a little bigger?
You need a little bigger.
Yeah.
I can see that, and I'm half blind.
Me too, and I still can't see it.
All right, I'll see what I can do. I have limited, scroll down to get the other line items here. So take a minute or two.